Hello, my name is Peter Hewston and welcome to our second CD in the series of the Sins of Directors and Shareholders. Following on from our first CD, the third sin I should like to come on to is about having an understanding of what the real value of your business is. Here we're looking from a financial angle. It is hoped that in its lifetime, a business will provide the owners with a good remuneration package, the ability to control their time, and potentially provide a payout from a sale of the business in the future. Many business people rely on the sale of their business to represent their final payout and pension. People often ask us what happens to private businesses over time, and in particular, where do we think theirs is going? Essentially, it depends on the sector, its size, and lots of other factors, but unfortunately, many businesses simply just fade and die. Yes, there are some that get sold. My anecdotal evidence is often that those who do not expect to sell, sell, and those looking to sell find it difficult to find a buyer. This may be because of the nature of the business, the dependence on the proprietors, and other factors. This is my subjective experience. Therefore, the important thing to recognise here is that rather than rely on a sale, you should endeavour to make yourself reasonably wealthy during the business lifetime to support your dotage, using the extractions you take from the business during its lifespan under your ownership. Obviously, it's not possible in the early years to extract too much money. The business needs to grow and the company needs to establish itself in its particular market, and its need for cash will prevent large extractions. However, when the business reaches a certain age, it should be providing the owners with a certain level of income. It's often said that as a minimum, if a proprietor is not receiving at least, say, $50,000 in a remuneration package from the business he or she is running, you have to wonder whether it's worthwhile running the business at all, given the risks and pressure involved. I'm aware that people set up a business for many reasons, and not all of them are financial, but often the extra time and effort you put into a business well exceeds the effort you would have to put into working for another organisation to earn such a package. The whole idea is to make super profits, which I describe as profits in excess of a reasonable remuneration package. It is these super profits, extracted in the most tax-efficient way, which should lead to the creation of personal wealth, so that any potential sale of the business at a later date is seen as the cream on the cake. Over time, you will hopefully have become personally wealthy from the extractions you have taken. If you look at it analytically, if you're not taking a decent package out of your business and there is an absence of super profit, then there is a strong likelihood that the business is not really worth that much anyway. I'm aware that some people are trapped in their businesses and will say they cannot do anything other than the business they are doing, but such a situation should set the alarm bells ringing to reassess what can be done to make the business more worthwhile financially. The fourth sin that I should like to discuss ties back to the first topic discussed on CD number 1, i.e. the production of management information. We often find that the information that is put in front of the owners of the business is not used or not given significant weight. In other words, we often hear such comments as, "Oh, we've produced these for the bank," which means you do not actually use them yourselves for the running of the business. It is essential that business people have at least a reasonable understanding of what a profit and loss account means in relationship to cash. If you are not prepared to do this, you need to have advisors around who can put to you what they mean. The profit and loss account is essentially the paper flow of the business. You send out sales invoices with values in paper form, and you receive purchase invoices in paper form with values. And other than for certain adjustment for depreciation, wages, salaries, and one or two other matters, the difference between these two sets of paper, in value terms, represents whether you make a profit or a loss. However, you can have a large profit but have poor cash flow, or vice versa, you can have a large loss and good cash flow, though that is only for a time. It is imperative that if you have management information prepared, you take time to understand it. Paying lip service to this means you are relying on luck rather than judgment to manage your business. The paper flow mentioned is what gets turned into cash, and the difference in speed of receiving cash from customers and paying suppliers and employees essentially dictates good or bad cash flow. You don't want to be a person who succeeds in spite of themselves, as eventually there is a high probability of failure and a huge reliance on lady luck. though I recognise we all need some luck now and again. This CD represents the third and fourth sins of owners and directors, and what they need to do to help ensure they understand certain aspects of the financial side of a business. This series will continue further into areas that often business people fail to understand. Liquidators, the funeral directors of the business community, often say the blame for any failure in a business lies with the management. The second reason for the failure is management, and the third reason is management. It's important to recognise that as your business develops, you have to grow with it, and often you have to go through changes yourself to meet the changing demands of the business. If you don't change as the business grows, then the business could easily leave you behind, but ultimately go in no particular direction. In other words, you often become redundant in your role as the business grows, because people are taken on to do the jobs you are doing. To avoid this, you have to reinvent yourself. So to summarise this series so far: 1. You need to measure the results regularly using recognised methods. 2. Look at the big picture to ensure you have an aim to arrive somewhere in the future, and don't just live aimlessly day to day. 3. Understand that on a day-to-day basis, what you take from the business is the real value in your business. This value can be personal satisfaction, the freedom to use time as you want, and the money you have available for use in your life. And 4, get an understanding of management information, however much you dislike the subject. If you'd like to discuss any of what you've just heard, please do not hesitate to contact us. Contact details can be found on the website www.rochesters.co.uk. We provide not only a compliance service, but a business advisory role, covering what we've talked about today plus much more. Obviously, all our initial meetings are without cost or obligation. Thanks for listening.